Hello, everybody. Thank you for joining us for today's public webinar. It's been a while. Thank you for joining us. Hello, Jim.
Hello. Okay. We do these in order to draw attention to educational programs that we have coming up. Jen, I forget the dates, but we have our introductory program is called a primer. It's our lowest cost program, particularly if you sign up early. But it's to give you an idea to see what we do, how we present, and what we talk about. Jen, what are the dates of the primer?
It runs from December 6th through the 14th.
It's an 8-day course. First 4 days are linear, which is not my preferred way of teaching, but it does give people an idea of the basics. And in the last 4 days, we use live markets, do daily reports, etc. We'll come back and do a fuller commercial a little bit later. But let me start off with a couple of things. First of all, take yourself back to last Friday afternoon. Last Friday afternoon, every short-term trader in the world for the last 3.5 hours was selling the market short. Market opened on Sunday night, and we've never looked back. Now the market's had this tremendous rise over the last few days, and here we are on Friday afternoon, and I can tell you that this is short-term traders once again being long. How do I know that? First of all, I look at the NASDAQ. The NASDAQ low in B period was exactly at the opening. The NASDAQ low in E period was exactly at half back. When I look at the market in front of us, the E period low is exactly at half back from D period. I know that those are characteristics of where short-term momentum traders buy the market. While they may, get priced to move with them for a while, but that is an indication that is short-term buying in the market. Remember, like I say, last Friday afternoon for the last 3.5 hours, they shorted the market. And you know what happened? Now, the next thing I want to chat about is we've had 3 upward gaps. The first gap was only a couple of ticks, but it is a gap. The last 2 gaps have been exceptionally large. Historically, the largest alert that I have seen as a short-term trader have been gaps. And 3 gaps, I have seen as many as 5 gaps. But 3 gaps, usually to me, is a warning sign that the market has gotten tremendously overdone. And it's a huge warning sign. Now, a lot of times, these counter auctions or corrections don't happen right away, but it's usually an indication that the market has gone and got excessively long or excessively short, depending on the directions of the gap. When you look at the market when it came down going into last Friday, the profiles themselves had been very stretched out. When the profiles are very stretched out, meaning very thin as the market came down, there's no backing and filling or sideways movement. As the market came down, a better way for the market to come down would be to come down, move sideways, consolidate, move down, move sideways, consolidate. That it gives the market time to digest the break. But it didn't. We hit we hit the low. It was a 3-month low. The market really did no backing and filling as it came down, and it set the stage for a huge rally. Now let's reverse that and say the current market has, with these gaps, these huge gaps, has gone up, and there has been no backing and filling as the market went up. It's just huge. The last couple of days have been just, and particularly yesterday, massive short covering in the SPY, massive short covering in the QQQ, massive short covering in the long bonds, which brought the yields down, which got all the traders excited. So I put that out as caution. I don't know what's going to happen. I don't have a magic ball, but I do know based on what I have seen historically, that the market is in a very vulnerable position to the upside. Now, the momentum indices, which are only based on price, will probably show that the market's strong. What we do is we put context around momentum, and we put the context around it. I get a different picture. Okay, Jen, why don't you do a commercial for the primer coming up, and then come back and I'll take a series of questions, please.
Okay, 1 second. Let me take the screen. Okay, so this information is posted on our website. If you go to jimdeltontrading.com and then courses at the top navigation, you'll see that the primer here is featured up at the top because that's the next live course, and it's running from December 6th through the 14th. And just something that I'll mention for those that are familiar or have heard of the primer before, for the first time ever, WindoTrader is offering a free trial of WindoTrader Blue for a full month to students that sign up for this December primer. The two eligibility rules are that you must be a new subscriber to WindoTrader, and also you must be enrolled in the December primer. More information and details about this will be sent out to students that are signed up for the primer on starting November 8th, I believe. And we will be having some webinars to help support and get things set up properly and how to sign up properly so that you can take advantage and maximize for this offer. But that's a $285 savings. And so if you think right now the primer is only $389, and you can get set up on WindoTrader if you're new, so that your charts can mirror ours for the purpose of the primer, and get started with that. That's a steal of a deal. But the primer is also great for people who are still trying to figure out, hey, do I want to jump down this rabbit hole of learning market profile? Maybe you've taken other trainings and courses and been burned or spent a lot of money. This is a real inexpensive way to figure that out, and also figure out if you like the way that we look at the markets. Just a really inexpensive course that we feel most people get you get a lot out of it, and you'll definitely figure out if market profile is for you or not. Also, if you are not able to attend all of the sessions live, all of the webinars are recorded, and you will have access to the materials for 3 months after the course finishes, so that you have time to review. If you got any questions, you can type them in here. I'll try to answer more at the end, or feel free to contact us. Bottom of our website, phone number here. I'd be happy to speak with you to help you figure out what's right for you if you've got additional clarification questions, or you can shoot us an email, delton@jimdeltontrading.com. But
Okay.
the schedule is also here for you in case you're wondering. All the times are posted Eastern time. Obviously, this weekend we will be having a time change, so it'll become EST rather than EDT here. But so adjust for your time zone, but this is the schedule here so that you know what we're covering approximately, and the timings of those webinars. Okay? Okay. Give you the screen back, Jim.
Okay, thank you.
There you go.
So Jen mentioned that there's a time change this weekend. I live in Arizona, and we don't change time. So it really messes me up. Part of the year, I'm on the same time as it is on the West Coast in Los Angeles. Other times of the year, I'm an hour difference. And then to make it even more confusing, some of the Indian reservations in Arizona don't change times. So anyhow, okay, we are open for questions.
Okay. Let's say you have a poor high in the A and B period, but this high was put just at the end of A period, and the beginning of B period with a short time between them. Do you still consider that a poor high?
Yep, it's a question. When I first, those of you that may know the history, when I was introduced to Pete Stottlemyre, he asked me if I wanted to sponsor his book, and I wrote him a check for $10,000. And then I took his courses, and one of the first questions I asked was exactly that question. And part of that was because, I was looking for exactness. And over the years, the way I answer the question, it either is a poor high or a weak high, or it's not. Don't be too exacting on the market. The market is not a science, it's an art. Okay, other questions?
Okay, the last large gap up from June 1st took until late October to fill that gap, a very long time. Best to forget about the gaps, as they generally are a shift in the market as they represent short covering. Do you agree with this?
Yes. Yeah, and it's, and of course, this was just massive short covering this week. One report I've got is that the loan desk, the equity and bond loan desk for shorts was the busiest day of the year so far yesterday. Yeah, there's massive short covering in there. But remember this, and when the market gets too short, it strengthens a market. Because how do you have to, when you're too short, you eventually have to buy in that short. So what we saw was the market, it hit the low for the year. We had a 3 month, I mean, sorry, not both the year. We had a 3 month low in there, massive shorts in the market. And that provides a certain type of strength because you have to buy to cover the shorts. Now, the other side of that, when you have a short covering rally, particularly the magnitude of the one that we've experienced this week, that can have the opposite effect. That can lead to weakening the market because it removes all those shorts. And then you get, along with that, you get a lot of momentum traders in particular that get to the long side of the market. So then the inventory can get too long. Now, I don't know if that's going to happen, but it wouldn't be unlikely that that scenario works out. The healthiest thing for the current market would be for the market to have, a meaningful correction, stabilize, and then begin to move higher. Now, I'm not saying it's going to do that. I'm just saying that would be the most meaningful thing to happen. For the market to continue higher increases the risk of being long, just like being too short last Friday increased the risk of being short. Okay, other questions?
Okay. Do you think that the gaps will be filled in the coming days or weeks?
Remember, trading is an art, not a science. And sometimes it takes a catalyst in order to get that process underway. Because right now, remember, so many traders are momentum type of traders, which means they're only looking at price. So what happens as you get these gaps and the markets move up, it adjusts the momentum indices higher. So that causes short covering, but it also brings new momentum buyers into the market. And sometimes the market just has to run its course in there, but it gets longer and longer. Like I say, go back and think about last Friday. We spent 3.5 hours trying to put in a low in last Friday. It would rally, they'd sell it, would rally, it would sell it, they rally, would sell it. And, markets get a tone for the day. And everybody knows, the way to make money is to buy it. Well, then all of a sudden you get a chance to think over the weekend, and it's a totally different market on Monday. And some of the things I'm looking at, if you look right here, the E period low is exactly at half back from D period. Okay, now, yeah, the market's up a lot, but this is not where longer term money comes in to buy. This is where shorter term momentum buyers buy at exacting levels. That is a clue that we look at. And like I say, we've got the same phenomenon on the NASDAQ. So markets get overextended short side, they get overextended long side. Okay, other questions? I mean, it's filling the gaps. You know, you go one at a time. So right now we're one time framing higher. We've got the gaps, and then you're always looking for change. What you don't want to do is one of the things that I say very often to traders. You are generally better off being a little bit late rather than a little bit early. There's an awful lot of traders out there that, you know, I'm sure are fading this market or going against the market. And yet it's just, and sometimes that drives the markets higher because when the people prematurely short, that adds, and then they have to cover, that adds more buying to the market. So a lot of times people try and time the markets. Markets are very difficult to time. So a lot of times you actually have less risk by being a little bit late rather than being a little bit early. So once you're a little bit late and you get the momentum down on the downside and starts to move, you have a better risk reward situation. But you don't fight trends, you don't fight the current, you don't fight the current market. Okay, so you're better off being a little late than early. Okay, questions?
Okay. Do you use naked POCs as a guide in order to have a trade destination?
Absolutely not. Absolutely not. There too many people are consider that their research. That, you know, they look for things like that, and you're so much better off to the first thing I say is always start with trend. And even though trends come to an end, you're so much better off to be trading with the trend. And you're looking for excess. Like this morning, early on, we had excess, but you couldn't, they tried to sell it off and they couldn't. Short-term buyers came in as the market got down to the low. And so first thing is trade with the trend. Right now, the trend is up. Do I think it's a late trend? Yes, I do. Do I think the risk of being long is high? Yes. But also the risk of being short is high because markets are over when they're over in there. And right now the momentum is up. And you don't want to fight that. It's just crazy. Like I say, you have less risk being a little bit late rather than a little bit early. But I don't use exacting points for references. Okay, what else?
Okay, the low of this down leg had very little excess around 41.22.25, and also in the NASDAQ futures, very little excess. How is Jim putting context to this and carrying this forward? I see all over the media people already talking about a year-end rally, but the lack of excess on the lows leaves me skeptical that it will hold.
Okay, remember, if you've listened to us over a period of time, a lack of excess can also be an indication. If it's excess on the low, it can be an excess. I'm sorry, it can be a market generated information that the market is too short. Likewise, lack of excess on the high can, I'm not saying it always is, but it can be an indication that the market is too high. Think about when you're short, you know, and also getting nervous. It gets down to the low and you cover. It gets down to the low and you cover. So excess is important, but you always have to understand that lack of excess can also be very meaningful because it may mean that the market is too short, which is what happened, you know, last week. Okay.
Okay. Can you speak to any changes that you've seen over the years due to the introduction of algorithmic trading and other effects, if any, on the profiles and volatility?
No, I really haven't. I was asked that question. I remember the last time I was asked that question, I was at a speaking in Las Vegas at Traders for a Cause, and you know, do we have a lot more volume? I mean, I've been trading for 50 some years. Do we have a lot more volume? Yes, but and there's been changes to that, and there's, there's zero dated options, and there's all kind of things. But the basic, if you think about it, the basics of any market that's financial in nature, and clearly short-term trading is financial. The three elements to any market that's financial in nature are time, price, and volume. Price advertises opportunity, time regulates all opportunities, and volume measures the success or failure of the advertised opportunities. I don't care if that's lawn services, cars, homes, or, futures or stock trading. Those are the elements of any transaction that's financial in nature. They remain. Yet, do we have more volume? Yes. But you brought up an interesting point, and I want to talk a little bit about volatility. The VIX, not too long ago, as the market was, going down, the VIX got to 12. And then all of a sudden, the market accelerated to the downside, and the VIX shoots back up to 22. Now, the market's had this huge short covering rally in the last 3 days, and guess what? The VIX has dropped to, it was 15 the last time I looked this morning. So the VIX is telling us that the risk has gone down substantially in the market. I've never liked the VIX index, and I've never liked the index itself. It's based on the purchase of puts. But when I look at the three gaps and how strung out this market is, I don't accept the fact that the VIX is correct, because the VIX is saying that the risk is minimal in here. Okay, what else?
Okay, when you say, with regards to the market, got too short, do you mean literally that too many traders were shorting the market, or do you sometimes use that phrase got too short to mean that traders or institutions, et cetera, do not own enough of the market?
No, I meant that they, well, it can be both. That's a great question. What I was talking about, the point that too many people were actually short, inventory was short. And as I said yesterday, I talked to one source that runs one of the major trading desks in the world. Massive short covering yesterday, massive short covering in the triple Qs, in the SPY, particularly in the long end of the bond market. I mean, it was just, real short. And as I said, the lending desks were busiest day of the year so far. Now, your question, it also can be to the point where if institutions, investment money is underinvested, that has the effect of being short too. And of course, that's one of the things, going on. You've got people out there talking about the fact that there's a year-end rally, and there's so much they're talking about is seasonality in there. And you've got other people. There's always two sides to a market. Then you've got other people talking about just the opposite, that for example, this morning, the jobs report this morning gave a boost to the market. And I wrote last night in a report I put out last night that bad news would be good news for the market today. And of course it was bad news. It was under the estimate, and it was good news for the market today. But you're going to have different people out there saying, wait a minute, that is not particularly good news for the long term. It may spike the market short term because short-term traders are looking right over the hood, what's right in front of them. But you're going to have other traders and investors saying, now, wait a minute, this is not necessarily good for the market. That here we're going, and earnings have slowed down. I think earnings are, off a few percent from last year. The job creation is lessening. So again, you've always got two sides of a market in there. And I don't know who wins. I don't know who wins, but I do know that there will be another side talking about the fact that the numbers are weakening, is not good for the longer term market. Okay. What else we got?
Okay. Do you think that the market is looking for a place to facilitate two-sided trade?
Well, yeah, it hasn't found that yet. The market's a business. And like any business, unless the market can find a level where two-sided trade can take place, you don't really have a good business. And that's the market you've had this huge short covering rally, but the market has, as of now, has not found a level where two-sided trade can occur. But yes, that's what it's looking for. Generally, markets don't go, spike up, spike down. They generally go up, move sideways, up, or up, move sideways, down. But so far, from this huge rally from last Friday, we've not found a level where two-sided trade can occur. Okay?
Okay. Does Jim think in markets like today, with a lot of risk being long, do you think that the buy for developing value reasons is reasonable, or is it better to be flat and wait for a better short?
Well, no, I mean, you're making assumptions a short. I mean, remember what I just said. If you're going to short the market, the first thing I opened with, you are usually better off being a little bit late than early. Too much money is lost from people want to short the market. Oh boy, it's up this far, I've got to short it. That is very often suicide. They short the market, then they have to cover. They short the market again, they have to cover. You are usually better off, wait till you have an excess high, wait till you get a little bit of change, you get a little momentum on the downside, then you come in with your shorts. But so many people just, they can't resist it. In their mind, they go, oh, it's too high, I've got to short it. That is usually a suicide move. And that's not what professional traders that make money, that's not what they do. You may get, you'll hear stories about people that made, huge amounts of money because they shorted the market or they bought the market at the right time. But if you go back, and they'll get big news in the big press news. But if you go back and say, when, how many times do you hear about that over the years? They're big names for a few months or a year or so, and then they kind of fade. Okay. What else we got?
Okay. Regarding singles left behind, do you approach this similar to gaps?
No,
And
I
if the
don't.
singles from the regular trading hours gets hit in the overnight session but does not get hit the following regular trading hours day, do you consider that the singles are filled?
No, they're only filled if they're filled during the daytime frame trading. Okay, let me wrap this up, and I just kind of comprise what I said. Remember, a week ago today, for the last 3.5 hours, every short-term trader in the world was trying to short the market. The market would rally and they'd sell it. The market would rally and they'd sell it. The market would rally and they'd sell it. Go on for 3.5 hours. What happened? We opened up on Sunday and there was a double distribution down on Friday. The market opened above the lower distribution and it was all over. The market's been up since. Now, here we are a week later, and look what the changes take place. And here we are on Friday again. Nobody cares about the risk. Everybody they're buying the market all day long. Nobody cares about the risk. This is where the problems come in. Like I say, this market would be much healthier. If it would, go down. Give the market a chance to balance. Give inventories a chance to, to come into line. Okay. So again, but I also say, don't fight the trend. Too much money is lost fighting the trend. And too many people, you're better off being a little bit late rather than a little bit early in there. And you need to just take a breath and say, what's going on? We got a gap. Do I think 3 gaps signals risk? A lot of risk? Yes, I do. Did I say it's immediate? No, I didn't. But it's something to carry forward, and all of a sudden, if the market starts the other way, where it starts challenging, for example, the first gap it would challenge would be today. It starts challenging that gap. Okay, now you start thinking, what can happen? Are we going to have a little bit of rebalancing of the market? Okay, any final questions?
Let's see. Somebody was asking, isn't it better to just be long, buy all the weekly lows and swing it because the market only goes up?
I'm sorry. I'm sorry. I can't relate to that. Okay. So remember when we do the primer, the first 4 days are linear. We just go through, talk about value and then the market. The
I'll
last
take
4
the screen
days,
back so people can see
we
that. 1 second. Yeah, you can go on. Sorry.
the last 4 days, you know, we do the markets live. The live commentaries during the day. Live commentary is where I can type something in and it appears on your computer screen. That's my best way of keeping you up to date on what I see going on in the market at that moment in time. And then we do a report each day. And those reports will talk about what I
Well,
see.
that's for the latter 4 days. The first 4 days, what the primer really is made up of is the linear teaching portions from our foundation and application of the market profile e-course. We take those linear teaching portions, and that's the first 4 days of the primer. And something that differentiates the primer from the foundation e-course is obviously it's a live environment, so you can ask questions. And then also we go through the exercise of plotting the profile manually in case you're somebody that does not have market profile charts yet. And something that I failed to mention earlier is that you do not need to have market profile charts in order to do this course or our foundation and application of the market profile e-course. You're not required to have charts. Charts are just nice if you are training yourself to observe the market the way we do, or you're wanting to observe the market when we're not in class, that sort of thing. So, but you're not required to have them yet. Lots of people that are new probably would not have figured out which charting platform they want to go with yet. That's not a problem. But something that's different also for this specific primer is that WindoTrader is offering a free trial of WindoTrader Blue for a month. And that's a $285 savings. The two eligibility requirements are that you're a new subscriber to WindoTrader and that you are signed up for the December primer. And we will be having a couple of supporting webinars with regards to details on how to sign up correctly, as well as getting charts set up and so that they mirror ours. So it's a great deal. A great opportunity if that's something that you've always been interested in, but you haven't quite pulled the trigger, or you just wanna check out WindoTrader and see how that is, because they previously have not ever offered a free trial. Okay. If you have any other questions, by all means, please contact us. You can send us an email at the bottom of our website, dalton@jimdaltontrading.com, or give us a call at the phone number here, and I'd be happy to answer questions over the phone with you. And I guess we'll see you at the next one.
Well,
Thank
do
you
you
so
have
much.
a final market question before we go?
Oh, I did see some, but I think there's too many that we can't get through all of them, Jim. But do you want me to give you the charts back? You want
Oh,
to
no,
cover the
just if
market?
you have a couple of key questions. I mean, I'm in no hurry.
Okay, I'm going to give you the charts back then. I'll give you
Okay.
the screen. There you go. Okay,
Okay.
here's a question. We did not see any P profiles since last Friday. The only way we could have seen that the rally is short covering is by week lows. Is that correct?
No, no. I mean, if you're gonna understand that, understand what happened to the market ahead of time. Remember when I said the market for last Friday spent, 3.5 hours late in the day trying to go lower. The market had come down for multiple days and was very thin. You've got to understand that when the market does that, there was no backing and filling really, that the market's going to be very short. The inventory is going to be very short. So many times people want the magic. You have to be involved in the market, understand what's going on. And of course, you're down at a 3-month low. The market's 3.5 hours trying to go lower late in the week, and you've got these very thin profiles. The market's going to be short. And when the buying starts, those shorts are going to get squeezed. So you need a deeper understanding rather than is it a P formation or do you have no excess on the low? Too many times people are trying to make a science out of trading, and it's not a science. Short-term trading is about you be involved in the market. You get a feel for the market. And this is what we're trying to explain to people. All right, let me say thank you very much. Have a great week and a great weekend. Bye now.
Thank you so much, everybody. Take care.